You wake up on a Tuesday morning with decent income, solid work history, steady paycheck. The apartment is perfect. Right neighborhood, reasonable rent, exactly what you've been searching for. You submit the application with confidence. 3 days later, the email arrives. Application denied. Credit score too low. You call the landlord, explain the circumstances, offer references. She apologizes, says her hands are tied by company policy. The algorithm decided. Next week, you nail the job interview. The manager practically offers you the position on the spot, says they'll be in touch after the background check. 5 days pass. The recruiter calls. Unfortunately, they've decided to move forward with another candidate. You know what happened. The same 3-digit number that blocked your housing just blocked your income. The utility company wants a $300 deposit before they'll turn on the electricity. Your banking history flagged something. The grocery store card declines at checkout despite sufficient balance. Some fraud detection system you've never heard of made a determination. The landlord scrolls through screens you can't see, shakes his head at information you don't control. Your phone displays the rental application status. Under review, pending approval, awaiting verification. Every door requires permission from institutions that don't know your name. You thought independence meant earning your own money, paying your own way, making your own decisions. You were wrong. Your survival runs through gatekeepers with proprietary algorithms, and they hold veto power over every basic need. This isn't accidental chaos. This is architecture. Banking used to be optional. In the 1970s, people cashed paychecks at corner stores, paid rent with folded bills, settled tabs with handshakes. Informal networks handled most of life's transactions. You could survive, even thrive, without ever entering a bank. Then the fence started moving. Employers eliminated paper checks, mandated direct deposit for payroll processing efficiency. Landlords stopped accepting cash, citing insurance requirements and liability concerns. Government benefits shifted to electronic transfer only. Car dealerships required financing applications, regardless of cash offers. Insurance companies built underwriting around digital payment histories. Each policy change closed another exit. The unbanked population, those without accounts, found themselves pushed to economic margins. Nearly 6% of adults now lack banking access entirely. But being unbanked doesn't mean being excused from the system's requirements. It means paying more to exist. Check cashing stores charge 5% fees for accessing your own wages. Landlords reject applications missing bank statements. Job portals require direct deposit information before you can apply. Utility companies demand higher deposits from those without banking relationships. Every transaction now creates surveillance data that feeds algorithms you'll never see. These algorithms assign scores, calculate risk, determine access. The digital payment revolution eliminated alternatives while promising convenience. Meanwhile, the cage was built while we slept. Each year brought new requirements, tighter restrictions, fewer options. What began as efficiency became compulsion. Now opting out of banking means opting out of housing, employment, transportation, healthcare. The infrastructure doesn't care about your reasons. It only recognizes compliance or exclusion. She graduates in May with her degree, her family cheering, her future bright. The cap and gown photos don't show the loan statements waiting at home. $52,000 borrowed for 4 years of education. The repayment schedule stretches across 300 months. At standard interest rates, she'll repay nearly $90,000 before the final payment clears. That diploma cost her 20s and most of her 30s in monthly obligations. She takes the job that offers stability over passion because the payments start in 6 months, regardless of her dreams. 2 years later, she's ready to buy a small house. The mortgage broker shows her the numbers on a tidy spreadsheet. A $250,000 home requires 360 payments. The amortization schedule reveals the truth buried in the paperwork. She'll pay nearly $200,000 in interest alone. The house will cost twice its price by the time she owns it outright at age 63. But renting means higher monthly costs with no equity, so she signs. Now she carries student debt and mortgage debt simultaneously. Her credit card helped bridge the gap between paychecks during lean months. $5,000 balance, minimum payment of $125 monthly. The statement includes fine print she didn't read. At this rate, Payoff takes 18 years. Total interest paid exceeds $4,500. A temporary shortfall becomes a decades-long burden. Then her daughter breaks her arm on the playground. The emergency room visit lasts 4 hours. Insurance covers most of it. Most isn't all. The bill arrives 6 weeks later, $11,000 remaining after insurance adjustments. The hospital offers a payment plan. She accepts because the alternative is collections. Another monthly obligation joins the others. Now she's servicing 4 separate debt streams while trying to save for retirement, maintain the house, feed her family. Every financial decision filters through a single question. Can I afford to miss a payment? She can't change jobs because the new position's probation period might disrupt her payment schedule. She can't relocate because selling the house underwater means cash she doesn't have. She can't start the business she's dreamed about because the risk of income disruption is unacceptable when $1,700 in minimum payments hit her account every month. The debt doesn't just extract money, it extracts possibilities. By 35, she owes more than 3 years of her gross income. The payments are manageable individually, but collectively they form a cage. The system wasn't designed to help her build wealth. It was designed to ensure she keeps paying. 3 digits determine more about life than any resume ever will. 720 versus 640 makes the difference between accepted and denied, hired and passed over, affordable and unaffordable. Landlords see the number before they see you. Employers in finance, government, and security-sensitive positions check it before making offers. Insurance companies use it to calculate premiums. Drivers with lower scores pay significantly more for identical coverage. The score follows everywhere, determining access to opportunity. But nobody can fully explain how it's calculated. The algorithm is proprietary, owned by private companies, shielded from scrutiny. You discover the rules by violating them. Closing an old credit card account can lower your score by reducing credit history length. Checking your own score too frequently triggers suspicion. Having no debt makes you invisible to the system, which is almost as bad as having too much. The logic defies common sense. Fiscal responsibility sometimes produces punishment. 1 in 5 people has an error on at least one credit report, according to federal research. 5% have mistakes serious enough to result in less favorable terms for loans and insurance. Disputes are most common in Black and Hispanic neighborhoods, where error rates run twice as high as predominantly white areas. Yet these errors legally determine housing, employment, transportation costs. The system is opaque, often wrong, and absolutely determinative. 2 identical job candidates submit applications. Same education, same experience, same qualifications. One has a score of 710, the other has 630 after medical debt from an emergency surgery. The first gets the offer. The second gets a form email about moving forward with other candidates. Half of employers now run credit checks for at least some positions. The rejection never mentions the score, but both candidates know. The person denied can dispute the medical debt, but the process takes months while rent comes due weekly. The insurance agent pulls up your information, types silently, then explains risk-based pricing with an apologetic expression. Your premium is $400 higher annually than someone with identical driving history but better credit. You don't have a credit score. The credit score has you. It reaches into employment decisions, housing applications, insurance calculations, dating prospects. Some romantic partners check scores before commitment. The number has become a proxy for character, discipline, trustworthiness. Judgments made by an algorithm nobody outside 3 companies understands. The bank statement arrives with familiar dread. Overdraft fee, $35. The triggering transaction was $3 for coffee. The account was $2 short when the purchase processed. That coffee cost $38 total. Next day, another charge hits before the paycheck deposits. Another $35 penalty. By week's end, the account shows $105 in fees from purchases totaling $19. She's working full-time, living paycheck to paycheck, and the bank extracted 5% of her monthly income for the crime of being broke. Across America, consumers paid over $12 billion in overdraft and non-sufficient funds fees in 2024, nearly 50% more than previously estimated. The system is designed to maximize extraction from those least able to afford it. Out-of-network ATM fees hit record highs in 2025, averaging $4.86 per withdrawal. That's both banks charging simultaneously. The ATM owner assesses a surcharge, then your own bank penalizes you for accessing your money elsewhere. Monthly maintenance fees average $14 for basic checking, adding up to $168 annually just for the privilege of having an account. Many banks waive the fee if you maintain minimum balances, often $1,000 or more. If you can't keep that cushion, you pay monthly for being poor. Late payment fees compound across multiple debts. Miss one credit card payment and the penalty cascades. $35 late fee, interest rate increase, potential reporting to credit bureaus that lowers your score, which raises your insurance premiums and blocks your next apartment application. Free checking largely disappeared. Banks that once competed on service now compete on fee structures, finding creative ways to charge for basic transactions. Transfer fees, wire fees, paper statement fees, account research fees, inactivity fees. The revenue model targets the vulnerable. 9 in 10 checking accounts still charge overdraft fees despite public outcry and regulatory pressure. The upscale bank branch architecture stands in stark contrast to the financial stress of customers inside. Over 10 years, a working-class family pays $6,000 in fees for the privilege of being poor. This isn't banking. This is extraction. Every transaction flows through the same two gates. Visa and MasterCard control 90% of payment processing outside China. Combined market value approaches $850 billion. At the grocery checkout, restaurant table, gas station pump, the logos are identical. There are no alternatives visible. The duopoly processes over $11 trillion in transactions annually, extracting a percentage from each. Merchants pay between 1.5 and 3.5% in processing fees every time someone swipes a card. A small business owner reviews the monthly statement showing $2,400 paid just for the privilege of accepting electronic payments. Those fees get passed to customers through higher prices. Everyone pays the invisible tax. The infrastructure is designed with no exit routes. Cash transactions face increasing marginalization. Many businesses now refuse physical currency entirely, citing safety and efficiency. Self-checkout kiosks display card-only signs. Parking meters require apps. Rent payment portals accept electronic transfer exclusively. The payment networks position themselves between every exchange of value. International transfers require bank intermediaries charging 5 to 10% in fees and exchange rate markups. Someone sending money across borders loses a tenth of the amount before it arrives. Alternative systems exist in theory but face legal and practical obstacles. Cryptocurrency remains volatile and largely unaccepted for basic transactions. Barter requires matching needs. Direct cash exchange triggers suspicion at scale. Then your account freezes. The notification appears on your phone screen. Transaction capabilities suspended pending review. No explanation, no timeline, no human to contact. Suspicious activity detected by an algorithm reviewing patterns you can't see. This happens during rent week. The bank's automated system flags something, a larger than usual deposit, a transfer from an unfamiliar source, activity inconsistent with your profile. Customer service representatives read from scripts, offering no information. Federal law prohibits them from revealing investigation details. You're locked out of your own money with bills due and no access. The freeze can last days or weeks while investigators review. Banks can deny service, block transactions, close accounts without explanation or appeal. The Proceeds of Crime Act and similar legislation give institutions legal cover to restrict access first and investigate later. You discover that survival itself requires permission from payment processors who answer to no one. They don't just hold your money, they control movement itself. Every financial action requires their approval, their infrastructure, their terms. The monopoly is absolute because alternatives were systematically eliminated. While the digital revolution promised freedom, he decides to live without a bank account. Tired of the fees, the surveillance, the arbitrary rules. Cash only, he tells himself. Within 3 weeks, reality closes in. The apartment application requires bank statements uploaded directly to the portal. No exceptions. The property management company's policy is non-negotiable. He moves to the next listing. Same requirement. And the next. Being unbanked costs approximately $3,000 annually in fees just to access basic financial services. Check cashing stores charge an average of 2.3% to convert paychecks into money you already earned. That's nearly $400 per year on 50 weekly paychecks. The annual cost of cashing 12 government benefit checks averages $132, ranging up to $360. He pays more for being excluded from the system than he would pay to participate. The job offer arrives contingent on direct deposit enrollment. Human Resources explains there's no check option available anymore. Payroll processing efficiency requires electronic transfer. Without a bank account, he can't accept the position. Government benefits shifted to direct deposit or prepaid debit cards issued through contracted banks. No cash option exists. Utility companies demand $300 deposits from applicants without banking relationships. The algorithm flags him as higher risk. Rental car companies won't serve customers lacking credit cards. Insurance quotes come back 40% higher without electronic payment history. The Social Services Office displays a poster. Bank account required for program participation. Large cash transactions trigger federal reporting requirements. Businesses receiving over $10,000 must file Form 8300 within 15 days. Financial institutions report any cash deposits exceeding $10,000 monthly. Split smaller deposits to avoid thresholds, and you've committed structuring, a federal crime. The person attempting cash payment for a used car faces questions about fund sources. Suddenly, you're explaining legitimate income to suspicious sellers and potentially investigators. Civil asset forfeiture laws allow authorities to seize cash without criminal conviction if they suspect illegal activity. Carrying significant cash becomes evidence of wrongdoing. Alternative lending is criminalized through usury laws and anti-money laundering enforcement. Community lending circles operate in legal gray zones. Cryptocurrency faces increasing regulation and remains unusable for rent, utilities, groceries. The social stigma compounds practical barriers. No bank account signals unreliability to employers, landlords, creditors, even potential romantic partners. Financial exclusion marks you as risky, poor, potentially criminal. The system was designed with no exit. Participation isn't optional, when every survival function requires institutional approval. After 2 months, he returns to the bank, opens an account, accepts the fees and surveillance. The door out was painted on the wall. Resistance isn't principled, it's impossible. The complexity is intentional. Terms and conditions run 40 pages in dense legal language. Interest rate calculations require spreadsheets to understand. Dispute processes involve multiple agencies with contradictory instructions. The average person confronting this system experiences confusion, then frustration, then resignation. Learned helplessness isn't a personal failure. It's engineered into the architecture. The rules are deliberately opaque to discourage resistance. Debt creates golden handcuffs tighter than any employment contract. She dreams of quitting the toxic job, but $1,700 in minimum payments hit her account monthly. The mortgage, student loans, medical debt, credit cards, they all demand servicing, regardless of her circumstances. She can't risk income disruption. She can't afford legal challenges to erroneous charges. She can't relocate for better opportunities, because selling underwater means cash she doesn't have. The obligations control her decisions more effectively than any supervisor. Meanwhile, everyone around her carries similar burdens. Average American household debt exceeds $105,000 across mortgages, auto loans, student loans, and credit cards. The normalization is complete. Social gatherings include casual debt discussions. How much do you owe? What's your interest rate? Everyone has debt becomes an accepted truth rather than a warning sign. The legal framework protects institutions over individuals. File bankruptcy, and the record haunts your credit report for 7 to 10 years depending on the chapter. That decade of financial exile affects housing, employment, insurance, everything. Banks that fail receive government bailouts. Consumer Financial Protection Bureau rules limiting overdraft fees to $5 were repealed in 2025, potentially costing consumers billions annually. The asymmetry is absolute. Network effects make banking unavoidable. Employers, landlords, utility companies, government agencies, they all built their systems around bank intermediation. Individual resistance meets institutional reality at every turn. The entire economy functions through channels you can't access without participation. It's not your failure, it's engineered dependency. But understanding the cage is the first step toward navigating it strategically. The system won't disappear because you understand it, but understanding transforms you from victim to navigator. Harm reduction matters when escape isn't possible. Strategic banking choices cut extraction rates significantly. Credit unions offer the same services as corporate banks, but with lower fees, better interest rates, and member-focused policies. Switching from a traditional bank to a credit union saves between $200 and $400 annually through eliminated monthly maintenance fees, lower overdraft charges, and better loan rates. Free checking actually exists at credit unions, while disappearing from major banks. Debt prioritization accelerates freedom within constraints. The avalanche method targets highest interest obligations first, minimizing total interest paid over time. $5,000 across multiple cards gets cleared faster and cheaper by attacking the 20% rate before the 12% balance. The snowball method pays smallest debts first for psychological momentum. Both work better than spreading payments equally across everything. Pick one strategy and commit. Credit score optimization means understanding the game without becoming its victim. Keeping credit utilization below 30%, maintaining old accounts, and disputing errors systematically improve the number without worship. The score is a tool for navigating a rigged system, not a measure of worth. Community lending networks and financial literacy organizations provide resources beyond institutional banking. National Foundation for Credit Counseling offers free debt counseling. Prosperity Now connects people to affordable financial services. Local mutual aid groups create alternative support systems. Policy advocacy pushes back against predatory practices. Contact representatives about overdraft fee caps, credit reporting reform, payment processing competition. Collective action changes rules individual compliance cannot. You return to that apartment application with different knowledge. The denial still comes, but now you dispute the credit report error, request manual underwriting, offer additional documentation. Sometimes it works. When it doesn't, you know why and where the leverage points exist. This won't make you free. It will make you less trapped, more aware, strategically positioned within a system designed for your exploitation. The first tool is seeing clearly. Now you see what they prefer you ignore.